in a way, markets are much more attuned right now to the Fed, to the war in Ukraine, to what's happening in the supply chain. 95% plus of what happens with economic growth and for markets has nothing to do with Washington.
Austan, thank you very much for joining us.
Jamie, good to see you.
Right now, there's so many different topics we could cover, but if we could start by talking particularly about inflation, because I know that's something that you've written about in the New York Times, and what I'm interested in getting your view on is central banks were so in control, generally, of how they affected markets for such a long time. And more recently, fiscal stimulus has been like an even bigger, potentially sort of had a higher impact on what markets is doing. So how do you see like where we are positioned right now in terms of inflation and about the ability of central banks to actually control it?
Yeah, as I think of it, there's a danger to have a central banker-centric view of the universe where everything that happens on inflation is because of central bankers. And they beat themselves up, why didn't we stop this? And then they pat each other on the back and say, okay, we'll raise interest rates and inflation will go away. It's critically important to figure out how much of this inflation is from supply shocks and how much is from excess demand and stimulus, monetary or fiscal stimulus. The central banker-centric view of the universe really centers on that it's demand, and that the central banks, by raising interest rates, can cut the demand to get rid of inflation. But if you think a lot of it's coming from supply shock, that's not true. The central bank can raise interest rates and increase unemployment, but if the inflation is not coming from excess demand, that's kind of the recipe for stagflation. So those are the two big lessons of the 70s in the U.S. experience. I think one is if you get inflation persistent, it unhinges the expectations, and then you have a really hard time getting rid of it. But the other is if it comes from supply shocks, just the central bank acting alone is not going to fix it.
And is that your view that that's the current state of play? I mean,
that debate, and I guess I'd put a little more weight on the supply shock view than some people. Not that it's 100%. I do think that the Fed was slow to recognize. I fully understand why in March of 2020, when it felt like the world might fall apart, they would take extraordinary, unprecedented measures on both expanding the balance sheet and on the interest rate. I do think after about a year, it was clear that COVID would have negative effects, but it wasn't going to blow up the entire world. And so it probably would have made sense to inch ourselves back to something like the conditions that existed before COVID, rather than having to move more rapidly right now.
Right.
But that said, I don't really see how you could look at the U.S. experience where inflation ignited when the unemployment rate was around 7%. How you could view it, that's not supposed to happen in the model. If it's just coming off of demand driven, it should have been like 3 different times in the last 20 years or so, we've gotten the unemployment rate down to 4% or below. So I kind of, if you believe that it's 100% or predominantly coming from excess demand, you sort of have to explain why inflation would ignite when the unemployment rate is still around 7%, or measured of output. There's still a pretty significant output gap compared to where we thought it should be. Inflation really shouldn't start at that high of a level unless something went dreadfully wrong on the supply side. So if you get supply shocks and now you add on top of it old-fashioned supply shocks like war driving up the price of oil, the Fed's got to be mindful of that, and we still have yet to see that shoe drop. I guess I would say it's going to be important going over the summer and into the fall to see whether inflation's cooling down. If not, or if so, the kind of the blowback about Fed action, that they should tighten, but if they tighten too much, they're going to generate stagflation. We still have to have that conversation.
Right. You made an interesting point in I think a New York Times article you wrote, that the Fed is going to have to consider how inflation is going to affect different income level families. Now, what exactly did you mean by that? I mean, inflation does hurt people from different economic, backgrounds in different ways. But when you said the Fed is going to have to think that through, what did you mean?
The first is just the factual matter. It was a piece I wrote that was drawing on a series of relatively new research by economists, where they got granular, really detailed data on what's each individual person's inflation rate. And if you look at that, it depends what you buy. If you're a person who drives 30 miles to work each day, then when the price of gas goes up, your inflation rate is going to be affected more than somebody who rides a bike or something like that. And by that idea, this research has shown that over the last 15 or 20 years, inflation rates have been systematically higher for low-income people than they have been for the middle class or for high-income people. The Fed outlined a framework before COVID, before we saw inflation, in which they were explicitly were mindful of the way the dual mandate should be applied or could be applied to different groups. So they were cared about full employment, but they were particularly going to be mindful that some groups' full employment doesn't look that great.
Yeah.
And so that when they're setting policy, they were sounded like going to try to address some of these issues of income inequality, of differences in standard of living across different parts of the income distribution. My only point was, you got to think about inflation when you do that too. So everybody's looking at unemployment and income and wages, but it's important to think about the inflation across the income distribution as well.
So you mentioned the labor market, which is reasonably tight right now, and I'm interested what you think about immigration rules that have changed over the last 5 years with a previous administration, and there's something like 2 million less jobs, I think, coming from foreigners coming to work, and that's just legal immigrants. What does that kind of dynamic going to do? I mean, how does the labor market?
It's awful. I mean, it's been devastating to the U.S. labor market. If you look in pre-COVID times, pre-Trump times, almost half the growth in the labor force for the U.S. was coming from immigration. And part of that was centered around the decline of that. Part of it came from restrictions on immigration in the Trump administration, especially on the legal side. All the public fighting is about illegal immigration coming over the border from Mexico, but the gutting of visas, student visas, high-tech visas, all different sorts of legal immigration to the United States. That's been that's been a very significant impact on labor force growth and jobs, and that got magnified, of course, once COVID began and there were restrictions. Nobody could travel. You can't leave your country. Can't go to another country. I don't actually think that we can get back to where we were before, unless we also have a reestablishing of that pipeline of immigration, because the demographics of the U.S. native-born population look just like the demographics of Europe, of Japan, of China, and other rich countries, which is to say bad, not the population slowing substantially or even declining. And so only immigration gives us that growth.
And to take that a step further, do you think we're now in a period of sustained deglobalization? I mean, we had globalization for so many years. Do you feel now that deglobalization is set to be with us for a long time, which is obviously inflationary as well?
Maybe. It's certainly been felt deglobalizing the last 2 years.
Yep.
I guess I'm a little skeptical that it's going to truly go away. But part of that for the U.S. side depends on what happens in the elections. I mean, before COVID, there was clearly a heightened trade war kind of tension from the Trump administration. If Trump were reelected, I think for sure we would go back to that kind of dynamic.
Okay.
If Trump were not reelected, I still think there's big economies of scale. You can see in the problems of the baby formula in the U.S.
Right.
in the near term. It's not like having a America First approach solves the problems. I mean, in this sense, it created the problems. If you want a secure supply chain, it's better to diversify even outside of just your own country. So I'm not sure.
You mentioned the elections. I know we've got the midterms coming this year. As you look out ahead, if I was to try and draw you on how you think they may go and the sort of impact they could have either way on markets, how do you feel?
Well, it's for sure the history says they're going to go real badly for the incumbent party. So I don't see
they typically do.
They typically do, and you add on top of it, there's a lot of discontent, a lot of partisanship, and a lot of discontent about the economy. So, look, I think it's going to go badly for the administration. It is very likely to mean they can't do much on a legislative basis. That's not unusual. That's usually in a way, we have one-year terms for president. You come in, almost everything you're going to do legislatively, you do in that first year. And so that part, while frustrating for a White House, is not any different than any previous period that we've had in the country. What that means for markets, I don't think a lot. Kind of joke, at a previous midterm, somebody asked me, what do you think's the chance that they are able to reach some bipartisan major legislation before the election? And I said, 0%. Yeah. And they said, well, does that change in your view if, at that time one party, but now the other, if the Republicans here win big? And I said, yes, I would cut that probability in half. If that happened, nothing will happen. Yeah. In my view, nothing will happen. And in a way, markets are much more attuned right now to the Fed, to the war in Ukraine, to what's happening in the supply chain. 95% plus of what happens with economic growth and for markets has nothing to do with Washington. And 7 out of 8 years, that's what this usually is. There's gridlock in Washington. They don't do anything. The presidential term's 1 year long.
Yeah. Well, it's a tough time to predict markets right now, but Austan, thank you so much for your time. It's really great to have you.
Jamie.